Hello and good day to all friends. I am Mojtaba Rasti from the Thales team, and today is November 30th, 2025. I'm here to present a long-term 6-month report targeting a maturity date in June. The idea is to take a long-term look at Bitcoin. As you can see, this report was actually prepared about a week ago, and now I am presenting it to you. Alright, we'll start with the Thales heat map. As you can see, the trading volume for the 2026 maturities, that is the January, March, and June maturities, has been reviewed. The highest trading volumes are for the strike prices of 90,000 and 85,000. As you can see from the heat map, this has happened. Of course, a week ago, we were lower, the price was lower, and there was more fear in the market. Most of the volume belongs to after early November. Here, you can see that after November 1st, most of the trades for these maturities have taken place. Out of about 55,000 Bitcoin, more than 30,000 Bitcoin belong to put contracts. If we filter here, we can see that the larger volume is with put trades. In this slide, you can see that we've moved the slider forward and... Alright, I will continue. We have filtered and considered the trades from the beginning of November to January 30th in this slide that you see, specifically for January 30th, 2026 in the second database. You can see that we are facing a volatile situation, where the lowest point is around 81,800, the maximum profit is 95,000, and the highest point observed is 112,000, for the month of January actually. In the next slide, you can see that if we move the slide forward and consider the trades from November 17th, both the trades and the entry, the floor and ceiling of the volatility drop significantly. The volatility floor reaches 58,800, and our peak profit is at 9,800, and the ceiling also drops to 105,000. That means the more recent trades, compared to the date we considered, around November 24th, which we analyzed, trades closer to that date have brought the volatility down due to the price conditions and the fear present in the market, lowering both the floor and the ceiling. So in the next slide, we actually filtered these same trades from the beginning of November to January 30th, but this time we only considered trades above 100 Bitcoin. You can see that the situation is still volatile, but traders have set higher floors and ceilings. In other words, larger traders with heavier trades have set higher floors and ceilings for January. The floor is 88,400, the peak profit is 109,500, and the ceiling is 123,000. Here you can see that, interestingly, despite the fear dominating the market, the big players making large trades have had a more bullish outlook on the market. Now, in the next slide, again with this group of 100 Bitcoin trades, we moved the slides forward to November 17th. Once again, you see that as we get closer to more recent times and more recent trades, fear takes over the traders again, and the numbers decrease. If we want to consider the point where the red curve intersects with the break-even line as the floor has dropped significantly to 45,000, the peak profit is 70,000, and the ceiling is 105,600. In the next slide, we continued moving the slider forward and considered trades from November 20th to the end of January. Again, you can see that in trades closer to the present time, the estimates improve. The floor rises to 78.8, the peak profit increases to 99.8, and the ceiling goes up to 113.4. All of this is influenced by that period when we actually saw the floor drop to 80,000. Well, a lot of fear dominated the market then, but as trades move forward, you can see that along with the recovery and upward movement in price, we're seeing a better and more bullish outlook among traders. So the previous slide was actually an analysis, as we said, of November 20th. In this section, you can see that among these traders, specifically those with trading volumes of 100 Bitcoin or more for January 31st, the majority are sellers, with put sellers having the upper hand. This is another important point. Most of the sellers are actually put sellers, and overall, they see the floor for January at 86,000. There are two trades of 1,000 Bitcoin each that really stand out in terms of volume. One sees the floor at 95,000 and the other at 90,000. There's also a particularly interesting trade in terms of timing, a 200 Bitcoin put sale. Look, this 200 Bitcoin put sale was made on November 22nd, which was right around the time we saw that floor and the fearful conditions dominating the market. Its strike price is 112,000, meaning that in those conditions, someone sold a 112,000 put for January, which is quite remarkable. They basically saw the floor at that point. In the next slide, again, you can see that among these trades of 100 Bitcoin or more, there are about 1,360 Bitcoins using the long strangle strategy. So in total, for trades of 100 Bitcoin or more that are for the January expiry, we see 3,360 Bitcoins using the long strangle strategy. We've gotten very close to the bottom of this long strangle, meaning we're very close to the target of the put buyers in this strategy. Here, this dotted line, no, not the previous one, the red dotted line with the red arrow, shows the price at the time of reviewing these trades, and you can see we're very close to this bottom, and in a way, we've reached it. Well, they didn't want it to go below 80,000 either. Now, the question is it time for us to move toward estimating the call buys, where the call buyers are targeting 128,000 for January? Now that about a week has passed since this review, we can say that we might actually be moving in that direction. The next strategy found among these 100 Bitcoin trades is two bull call spreads with a total value of 1,020 Bitcoins. Two bull call spreads with a value of 1,020 Bitcoins, where their break-even point is 103,300, as you can see here. And in fact, their mid-profit point is 106,300, and their maximum profit is around 110,000 or 109,900. These trades were also entered on November 14th, right where you see here, and again, they have a bullish outlook for January 30th, but it's a limited bullishness. In other words, they've set a cap for the upside, meaning we shouldn't expect any crazy rallies until January. This strategy shows that a ceiling has been set, and that ceiling is 110,000. Now let's move on to the next strategy. Another strategy we can find is a short butterfly with a value of 400 Bitcoins, and again, you can see that the target is actually lower, and it's currently being realized. In this strategy, the trader has the potential to profit on both sides, but in the middle, where they don't expect the price to be, they would incur a loss. The maximum profit on the downside is sought at the price of 80,000, which has pretty much been achieved. We've reached the 80,000 floor. So we can expect a move toward the upper estimate of this strategy, which is 120,000. That means the trader sees the maximum downside is 80,000, so in a way, you could say that's why the maximum drop is seen as 80,000. Here, they've closed their profit and don't expect it to go any lower. On the upside, if the price increases, they don't see it going above 120,000 for January 30th, so on both sides, they're in profit. Again, this is a 400 Bitcoin strategy, and we can observe it here. Next, we filtered the trades from the beginning of November up to now, up to around November 24th, for the March 27th expiration, for the March 27th, 2026 expiration in the second database. You can see that a bearish outlook still dominates the curve overall, moving toward 82,300, and then the delta peak is at 74,000, according to what you see here. The delta peak is set at 74,000 here. The price was roughly around here and is moving toward 83,000. This is the point where it enters a loss, as shown by the red curve. The delta peak, which is at 74,000, is the key level. If it drops below 74,000, you'll see the delta turns negative and put buying actually begins. And the red curve starts to show profit from 67,000 onward. The peak profit of the red curve is actually on the side. The peak of the red curve is around 105,000, and the ceiling here is about 118,000. What's clear in this curve is the volume of call selling, in a way. That is, you see, as the price increases, the delta keeps steadily decreasing. A large range has been considered by the traders as a ceiling, where the price is likely to stop somewhere within it, and the ceiling is actually realized. We've brought the slide forward to November 17th, and you can see that the downward movement intensifies for the month of March, and they actually see below 75,000 as profitable. There's a heavy gamma almost at 60,000, which comes from buying puts for this section. On the other hand, there isn't a negative gamma on the upside that's noticeable. That is, on the upside, there's also a negative gamma at what level? At around 120,000, which is the ceiling. You could say we can see 120,000 here, but this ceiling starts from about 100,000. This call selling starts from about 100,000, and its peak is at 120,000. So we still see trades in that range we considered for March, and there's a bearish outlook from November 17th, from the incoming trades from November 17th. Well, the contracts. In this slide, you can see that we filtered out contracts above 150 Bitcoin for the month of March. As you can see, at the time we were doing the analysis, we were very close to the delta peak. Here's the price, and we're very close to the delta peak, meaning the floor is around 74,000 to 78,000. If this floor is broken, the move would head toward the average purchase price of the puts, which is actually 50,000. But the necessary condition for moving in that direction, the point here is that moving toward that entry, the red curve turning profitable, requires a high tolerance for loss and paying a lot of premium. Look, if we go down from the delta peak, see to what extent the red curve goes into loss, and put buyers have to pay a high premium to be able to see the red curve turn profitable. So this is a point that somewhat reduces the likelihood of a move to those very low floors seen here. However, it's necessary. Moving upward isn't like that. If we move upward, meaning toward the highs, selling calls, you can see that the curve enters profit very smoothly. With just a small move, the curve becomes profitable. This can actually make the move in this direction a bit more likely for us. And the interesting point is that our curve on the upside starts to go into loss from this point. This is its ceiling, and this ceiling shows a value of 134,600. So, up to 134,600, the red curve is profitable, and beyond that, it goes into loss, which is itself another noteworthy point. In this slide, you can see that among these trades of 150 Bitcoin and above for the month of March, 4 trades with a total value of 3,400 Bitcoin stand out. Of course, they don't all belong to a single trader, there are separate traders as well, but if we add them up, 3,400 Bitcoin is significant. If we consider them all together, it's as if a single trader has adopted this strategy. You can see that such a structure forms, as if the trader sees volatility in the range between 82,500 and 134,000 as profitable until the end of March. If we look at this as a single trader, it's as if this trader sees the volatility between 82,500 and 134,000 as profitable for the month of March, up until March. And they've also limited their loss, of course. They've deliberately limited their potential loss because they genuinely feel there's a significant risk from a substantial downward market move. That's precisely why you can clearly see that their overall loss is effectively capped on the downside. They've limited their loss to around 79,000 because traders are actually afraid of a possible downward move. The 80,000 floor really stands out here, and at 79,800, let's just call it 80,000. The 80,000 floor is where this strategy as a whole was afraid it might drop below, leading to unlimited losses. That's why they closed it here. The 80,000 floor that we saw it and then bounced back up. And according to this strategy, we're now actually in the profit zone, in the range between 85,000 and 134,000. We've now entered this profit area. So this point is also very important. The trades we analyzed here include 2 1,000 Bitcoin trades, one 1,100 Bitcoin trade, and one 300 Bitcoin trade. These are large trades, as you can see here, and we've marked them with a check on the arrow. In the next slide, we filtered the trades from the beginning of November in the second database for the June 26 expiration. From the beginning in November, we focused on the June expiration as our final target, and you can see that there was a possibility of movement in both directions. At the time we prepared this report, we were closer to a downward move. Here you can see the dashed line, which actually points downward. This is the break-even point for put buyers, around 75,000. We were actually closer to this level. As we mentioned, those who were below 75,000 saw profits. The gamma of the trades, however, peaked at 60,000. On the upside, traders above 152,000, look here, call buyers above 150,000 saw profits, and the maximum loss for these traders was around 100,000 to 150,000. So these put and call buyers, by taking these positions, faced a maximum loss of about 100,000 to 150,000. We'll see later how call buyers set their expectations so high. The interesting point here is that you can see the curve is somewhat bullish. Let's move on to the next slide. We moved the slide forward and analyzed trades from November 18th onward for the June contracts. You can see that the overall curve takes on a downward shape again, and profits are seen below 64,000, with the gamma of this curve at 53,000 here. On the upside, the end of the bullish delta movement is around 115,000. But the interesting thing is the precise targeting you see here. It's quite fascinating. A precise target by call buyers and call sellers at the 180,000 mark. This is really interesting. First, look, moving downward, well, that's a loss, which means put buyers have to accept paying the premium to maintain their position. But on the upside, we see a very clear target and pinpointing here, with a peak profit on the red curve at 180,000. As we said, we'll analyze this number more for the June months. Let's go to the next slide. We filtered contracts of 100 Bitcoin and above for June and moved the slide up to November 18th. That is, trades from November 18th to about November 24th, and contracts of 100 Bitcoin and above for the June expiration. An interesting shape forms in the curve, as you can see here. In the middle, we're seeing a long strangle. Apparently, right in the center, there's a long strangle, and at the time we were analyzing the trades, we were almost at its bottom at the end of it. That is, we were at the point where the breakout to the upside had just happened. This long strangle is actually set up to profit from a move downward with a specific target in mind, and that's the important number, 75,000. You can see here there's a pinpointing toward the downside, as if the buyers and put holders are considering a possible move towards 75,000, a targeted move towards 75,000, which still seems to have a chance of happening. Right now, we're moving upward, but you can see that, in our analysis, there's still a probability and a chance for a downward move. In my opinion, with the week of trading we've seen, 75 might have faded a bit. We might head toward 80 or 81, but 75 has perhaps become a bit less likely. Still, you can see that, until June, we're not completely out of the danger zone. There's still a view toward the downside for 75. On the upside, though, the important and interesting point is that this long strangle becomes profitable from 137,000 and above. Look here, this long strangle on the upside becomes profitable from 137,000, with its ultimate limit at 180,000. That's really interesting. It's as if, even if you ignore the downside targeting here, from this point, if you're not seeing a bearish move, you're looking at a bullish spread. It's as if you're looking at a bullish spread that's actually targeting 180,000 for June, and the midpoint of its profit, the midpoint of the spread here, is around 150,000. It's 156,000, which is really interesting. Now, we'll analyze this further ahead, but on Friday, during this correction, you can see that on Friday, trades over 100 Bitcoin, 2 strategies, each with 3 legs, and a total value of 1,575 Bitcoin created such an interesting structure. It's a really fascinating setup. At the top, we see a bullish spread. Look, here we can see a bullish spread formed from the combination of these trades, which again targets a profit and a maximum limit up to 180,000. And at the bottom, we see a put purchase that actually yields profit below 53,000. The trader here has actually locked in profit at the top. They've locked in profit at the top and don't really expect anything above 180,000 for June. If we look at these, I actually think all of these trades belong to one trader, or maybe 2 traders with their own strategies. They've locked in profit at the top, but have left the maximum profit open at the bottom. That is, at the time when we were reviewing these trades, there was still fear or the possibility of a move further down because we were close to 75, almost at the 80 floor, and there was a lot of fear in the market. Traders still saw the possibility of a further drop. They saw it. For this trader, in a way, given the time left until June, we could see a move downward here, possibly towards 75,000, if we take the expiration as June. In fact, we might interpret it this way. This trader is considering a move up to 180 by June and then a reversal downward. So maybe we can say that after June, for example, it could be the end of the bull market. That is, first we go up to the profit target these traders have set above, and then we come back down. Because the profit was not closed from below, it was closed from above. Closing the profit from above means we want to see a level higher up and then come back down. And it's possible that after that, we break below the 75,000 floor and move further down. This 5,000 drop is very important. If it breaks, the bullish structure will be completely lost. Also, you can see that on this chart, we have turned on the theta index. Theta, as you know, is the time decay index, basically the time value of an option. That is, if you actually buy a contract. The option buyer always has a negative theta, while the seller has a positive one. Theta, the time value of the option, works against the buyer and in favor of the seller. This means that, in fact, if the price stays the same, the buyer loses money because they've made a decision, taken a position in one direction by buying a contract, but as time passes and the price doesn't change, the value of their contract decreases. On the other hand, this benefits the option seller because they're receiving the premium. Here, as you can see, we've highlighted theta on the curve, and you can see that moving upward is more beneficial for the trader because their theta becomes positive. If we move downward, theta actually becomes negative. This positive theta is more towards the upside, which is for the seller, and they can actually collect the premium. So from this chart, as I mentioned, you can interpret that the market is expecting an upward move until June, up to the numbers we discussed, and then probably a move downward. Now, this is just one interpretation, a possible analysis, and we might see movement after June as well. You could consider the market as bullish. Okay, let's move to the next slide. The largest trade among these transactions is 150 Bitcoin for the month of June. The biggest trade is the sale of 1,500 Bitcoin put options, where the trader didn't want anything below $75,000 until June. This was the largest trade. We had a 1,500 Bitcoin put sale for June 26th, where the strike price was set so that they didn't want anything below $75,000, and we had gotten very close to that level, but now we've moved away from it. So, this trader sees the floor at $75,000 until June, meaning they're saying we won't go below this number until June. This is a bullish outlook, and we actually got very close to it. And maybe we've already seen it. Maybe our bottom was $80,000, and now the market is moving upward, which itself... That's an important point. As I said, it could indicate a bullish possibility for the coming months. Okay, let's move on to the next slide. In summary, when we filtered the trades for June to only include those of 100 Bitcoin or more, the interesting point is that we observed 10 call option purchases where the strike price was set above $130,000 for June. Here you can see the check marks. There are 10 call option purchases for strike prices above $130,000 for June. 2 trades requested $130,000, 1 trade requested $140,000, 1 trade requested $160,000, 2 trades requested $180,000, 1 trade requested $190,000, and 3 trades predicted $200,000. So to break down these 10 trades, we had 3 trades that predicted a price above $200,000 for June. 4 out of these 10 trades, which include 2 trades at $130,000 and 2 trades at $180,000, entered the market on November 21st. So their outlook is relatively new and fresh, which I think is very important. These are the trades that really push the curve upward for June. They came in on November 21st, which, if I'm not mistaken, was right around when we saw the 80,000 bottom, right at the peak of market fear. These traders entered and bought these calls for those higher prices, so this is really significant. And finally, we have this slide. Well, not finally, because we'll also look at the heat map. If we activate all the January, March, and June expirations and consider trades from November 1st for all these expirations, you'll see that we're again faced with a downward sloping curve. The delta peak, as you can see, is at 75,000. We're back at that critical 75,000 level, which shows that this is a floor that shouldn't be breached. The delta peak is at 75,000, which is also a support level, and if it breaks, we'll move toward the gamma peak here, which is around 52,000. That would be the scenario marking the end of the bull market. If that happens, it's probably game over. But as we mentioned in the previous analysis, it seems that this outlook from traders isn't for the next 6 months, meaning a break below 75,000 right now doesn't appear to align with those bullish contracts we saw, which have a bullish outlook for the next 6 months. Also, keep in mind here that moving below 75,000 would require paying a hefty premium. You can see here that the premium would have to stay in the loss zone, the red curve, for quite a while before it reaches 52,000 and put buyers start making a profit. So this means paying a high premium and being in a loss for a long time, which reduces the likelihood of this move happening. On the other hand, with just a small move, the curve quickly turns profitable. The profit peak is around 96,000, and then we reach 106,000. Our next resistance could be where the gamma and delta curves intersect. You can see here, this could actually be a resistance point for us, where call sellers, in exchange for taking on risk, are at about 123,000, and the intersection of the gamma and red curve here is at 144,000.